Everybody, Mike DeSepoli, Heritage Financial Advisory. Welcome to Heritage Insider Weekly for Friday, August 23rd, 2024. Hope you're all having a great week and enjoying the last couple weeks we have left here of summer. We're back to update you on the markets and the economy. We had a big speech this morning, the annual Jackson Hole Symposium, Fed Symposium, followed by the speech with Jay Powell, which is really anticipated widely each year. Particularly this year's monetary policy is under close watch from market participants. And Powell really finally today let down his guard, made the pivot towards confirming what we already knew, which was the Fed was going to cut interest rates. They're on the path to cut interest rates. The exact quote you can see here on the screen: "The time has come for policy to adjust." So a very important point, milestone, if you will, clearing another hurdle in this giant monetary policy endeavor we've been through together over the last couple of years, from starting in low rates, extreme tightening up the curve, 5.5% of interest rate increases over the course of 16 months, guaranteed by every economist that it would throw us into a nasty recession. And here we are as Powell continues to tries to navigate his idea of a soft landing. So look for rate cuts to come through in September. Whether it's 0.25% or 0.5% remains to be seen. But markets are pricing in about 0.75% of cuts between now and the end of the year. So markets naturally reacting to that. It was a very short speech, 10 a.m. He delivered it. He was done by 10:15. And we've seen the markets react accordingly. So let's take a look at the market and what again, as you know, we are watching events like this. We are evaluating events, but we're not reacting to it on a minute-by-minute basis. We're concerned with the current trend and the longer-term trend that is. And again, holding up really well, right? The first thing after nailing the low, buying the dip, and you get a move out of it, what you would look at as a V-shaped, right? The first and most important thing, hurdle, if you will, that the market needs to clear is it needs to not immediately give back that gain, right? When you see a V-shaped recovery and the market immediately falls again, that would suggest that maybe it was as they would call it, a dead cat bounce. Okay, so first you want the market to at least hold the move. So as far as the week goes, unless something dramatically changes in the next couple hours, the market has met that threshold. So check the box for that. Second, we want to look at our under the hood, right? Our internal oscillators of the market and gauge whether we believe there could be continued strength. So you can see down here where my mouse is now, we had our buy point when the market internals started to turn up before price in the market started to turn up. And of course, we view it now and we say we have a ways that this market can go before it would technically be considered overbought, right? So when markets get overbought, they're due for a rest. When they get oversold, they're due for a bounce. And anything that happens in between, it's our job to figure out what that is. So you're seeing a good reaction off of that. We are at this point about 40 or so points from the previous all-time high. So there's a lot to be said about a market that goes through a correction and makes a beeline back to all-time highs. We won't put the cart before the horse, but there is some data that I will share next week if indeed we do get that new all-time high within a 2-week span. So very rare, and that's also something we're going to cover in a moment as far as the internals triggering a couple key signals for us here. But when we look at what happened today with Powell, you want to look at the underlying components and make sure that they're aligning as well. And when we look at the dollar index, as an example, you can see the reaction just as Powell began and delivered his speech, dollar falling. Now, I know you might look at this and say, well, that doesn't look like a good thing. This is the dollar index. You want to see the dollar index flat to down again for U.S. stocks. Let me just bring this out on a longer view and you'll see what I mean. And it tends to be a lot more supportive because there's no monetary headwinds, right? There's no currency challenges for multinational corporations. So a flat to weaker dollar tends to be a tailwind for U.S. equities. Now, we had drawn, our suggested double top idea a couple months back as we noticed that the market was making a lower high here. And so far it's played out pretty well. Excuse the elementariness of this drawing, but I think you get the general idea. And the same can be said for interest rates, right? Let me just readjust here as well. When we look at interest rates, they are heading in the right direction. Same idea there, double top. And remember, the 10-year yield with a 10-year bond is really what the Fed is looking to. So the Fed is telling you they're going to cut, but it was because the bond market told them that they're going to cut. And that's what we're seeing as rates move down. And as the federal funds rate comes down, you can expect interest rates to get back to a more normalized level on the 10-year bond. And then the last thing was when you look at the fear index, right, we talked about how this was a very important marker for a potential bottom in the market back on August 5th, a couple weeks ago. And if you look what the VIX does, the VIX did what it always does, which is has that temporary surge spike, marking maximum fear in the marketplace, and it's reverted back to where it was essentially on July 18th, right? So just like it never happened, except for the sad folks that probably sold all their stocks back on the low on August 5th. So thankfully, nobody watching this video did that. We would never let you make such a critical mistake in an important juncture in the markets. When we look at the markets, we just had another, so a Zweig breadth thrust was coined by a famous market technician, Martin Zweig, and it was basically looking at thrust is the number of stocks under the hood of the market that are making a move to all-time highs simultaneously. And we can see historically Zweig breadth thrusts don't happen a lot. It's the green dots on the chart. Now we've had a couple this year, which is exceedingly rare. 3 times in a single calendar year has never happened. So we'll see what the future brings. But we can see, looking at individual events in the past, it tended to be pretty bullish for the market with a 6-month and 12-month forward return with a 100% win rate. So I don't know about you, but I'll take anything that gives us a 100% win rate if we can get it. And then lastly, we're just looking at fear and greed in the market. We've neutralized here coming off of those extreme fear categories. This is good. There's not a lot of excitement right now about this bounce, but there hasn't been much excitement about this market for the last 18 months or for the last 2,400 points on the S&P. So excitement does not mean or match to actions in the market. We want to think about that actually in a contrarian way, where we like markets to climb and people to be skeptical about it, because when everybody's in the pool, then it's time for us to look for an exit. So I think we're a long way off from that, really, with the early innings of a lot of the major developments in technology. And speaking of which, let's keep an eye next week, right? NVIDIA is going to report earnings on Wednesday, the 28th, and that will be widely watched and much anticipated by everybody in the markets as the most important company right now in the development of artificial intelligence. So if you have any questions, as always, reach out to us. Always here to talk to you about anything that matters with your money. Hope you have a great day and a great weekend, and we'll see you back next week for Heritage Insider Weekly.